Once business owners have a good idea of what their business is worth, there are a number of strategies they may want to pursue to minimize taxes on the transfer of business ownership and to minimize estate taxes. One of the strategies is to take full advantage of the lifetime capital gains exemption, CGE.
In Canada, a lifetime capital gains exemption is available to owners of shares in qualified small business corporations. The requirements at the time of sale are these. The company must be a Canadian-controlled private corporation, CCPC, with all or substantially all of its assets used in carrying on an active business primarily in Canada. That is, assets representing at least 90% of the fair market value of all corporate assets must be used for active business purposes. More than 50% of the fair market value of the company's assets must be used in carrying on an active business primarily in Canada throughout the 24-month period immediately before the sale. The shareholder or someone related must own the shares throughout the 24-month period immediately before the sale. So business owners are advised to do some advanced planning to take full advantage of the lifetime capital gains exemption at the time of the sale of the shares in their private corporations. This strategy allows business owners to lock in the capital gains of their businesses that are subject to the estate freeze. The other benefit of the estate freeze is that it may also permit income and capital splitting. Business owners considering an estate freeze should make sure the value of their businesses are as accurate as possible for several reasons. Hence, the importance of getting proper business valuations conducted by objective and independent business valuation experts.
Let us move on to the benefits or objectives of estate planning. Could you expand?
The benefits or objectives of estate planning are many. Achieve a fair distribution of the estate of the deceased among the heirs, mainly family harmony, protect estate integrity, protect the interests of the most vulnerable heirs like minors, elderly, and disabled, privacy, an orderly distribution of the estate, keep probate taxes to a minimum, minimize and defer capital gains taxes where possible, and to minimize and defer taxes throughout life.
Estate planning is clearly important. Let us get a better understanding of the need of living powers of attorney and wills.
These are some of the estate planning essentials I will cover next. Shareholders' agreements, insurance policies, powers of attorney, wills, trusts, joint banking, and joint investment accounts, and beneficiary designations for registered accounts. For business owners in particular, the estate planning process should be focused on business succession for continuity in case of death, and to ensure that the heirs receive their fair value. Shareholders' agreements are key estate planning essentials for business owners that have partners in the business. Typically, the shareholder agreement details what should happen, the conduct of shareholders and processes, in the event of retirement, disability, or death of one of the business owners or shareholders. On the topic of insurance, privately held life insurance can help equalize the estate for the family and other heirs not in the business, pay taxes, and much more. Corporately held life insurance on the life of its shareholders and key executives can help generate capital for the business to keep going, can help the company buy back the ownership share from the estate of a deceased shareholder, and can be used as collateral against which to borrow money for business purposes. Other types of insurance should be considered by business owners since critical illness or disability can have a serious impact on the business's continuity. Questions to ask would be the objectives of getting insurance, what type of insurance, who would be the beneficiaries, who should own the insurance, and who should be insured. Questions to ask should be: what are the objectives of getting insurance? What types of insurance? Who should be the beneficiaries? Who should own the insurance? And who should be insured? Typically, there are three types of powers of attorney known in Quebec as mandates. 1. Non-continuing power of attorney for property or financial affairs. 2. Continuing or living power of attorney for property or financial affairs. And 3. Continuing or living power of attorney for personal care. 2 of these powers of attorney are estate planning essentials, whether the person is a business owner or not. Continuing or living powers of attorney for property or financial affairs allow a person's attorney or mandatory to manage a person's property and financial affairs should they no longer be able to do so as a result of mental incapacity or illness, but only while the person is alive. They can also serve to allow the attorney the power to manage the person's affairs in their absence or in their stead. Continuing or living powers of attorney for personal care allow a person's attorney or mandatory to manage a person's health care related matters should they no longer be able to act independently as a result of mental incapacity or illness while the person is alive. Questions to ask. Who should be the powers of attorney? Can they do it? The will. The will is another essential of estate planning. Wills only take effect upon death. To save on probate taxes, which are not applicable in Quebec and Alberta, some people and some business owners in particular might choose to create multiple wills. A primary will to deal with the assets that are subject to probate, like bank and investment accounts. A secondary will to deal with assets that are not subject to probate to save on these taxes, which are not relevant in Quebec and Alberta. The questions to ask. Who should be the executors or trustees? Can they carry out their duties? Who should be the heirs? Among other considerations, we might ask, are there minors to be considered? Are there heirs with disabilities to be considered? With regard to trusts, there are 2 types of trusts, inter vivos trusts and testamentary trusts. Inter vivos trusts are created during a person's lifetime. Example, a family trust. Note that inter vivo trusts are taxed at the highest marginal tax rate. A testamentary trust is created after a person has died. Example, your will. A testamentary trust is taxed at graduated rates. It can become a useful income splitting tool and contribute to tax savings. Questions to ask. Who should be the trustees? Should they be allowed to delegate? And what are the objectives of creating a trust? Who should be the beneficiaries? When should the trust be dissolved? Who should manage the investments of the trust? Should the beneficiaries be allowed to encroach on the capital in the trust under special circumstances? How much of the income derived by the trust should be distributed to beneficiaries and for what specific purpose? Any tax benefits? On the issue of bank accounts, joint bank and investment accounts with rights of survivorship, not applicable in Quebec. Having joint bank and investment accounts not only facilitates the transfer of these financial assets into the hands of the joint account holders, it minimizes probate and even contributes to tax savings through the deferral of capital gains. On the topic of registered investment accounts, RRSPs and RIFs, registered investment accounts with specific beneficiary designations contribute to the minimization of probate taxes provided the estate is not designated as the beneficiary. If a surviving spouse is the designated beneficiary, the spousal rollover of registered investment accounts does not attract any taxation on the death of the plan holder